All right, let's jump right into this. Welcome back to the Explainer. Today, we're throwing on our forensic accounting hats to conduct a highly skeptical, purely data-driven equity research audit of MACOM Technology Solutions, ticker symbol MTSI. If you've been following the semiconductor space at all, you've probably seen the absolute explosion of media hype around MACOM's 2026 growth numbers. But today, we're completely ignoring the sound bites. We're going straight to the raw financial statements, the SEC filings, and the earnings transcripts to figure out what's really driving this machine, and more importantly, if the underlying fundamentals actually justify all this market enthusiasm. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, here's our audit itinerary for today. We're going to start by tearing into those headline top-line numbers, then dissect the actual growth engines and evaluate their margin expansion. After that, we'll follow the cash flow, go hunting for hidden red flags, and wrap it all up with my final analyst take. Let's get to work. Section 1. The top-line explosion. Auditing MACOM's headline numbers. When a company posts numbers this aggressive, we have to immediately audit exactly what they're feeding Wall Street. $342.2 million. That's MACOM's reported revenue for Q3 of 2026. Now, sure, in a vacuum, a number is just a number, but the context here is absolutely wild. This represents a staggering 35.8% growth year over year. And even crazier, it's an 18.4% sequential jump just from the previous quarter. In the hardware and semiconductor space, jumping 18% quarter over quarter takes some serious operational momentum, but the real question we need to answer is this just a one-off spike, or do they actually have the pipeline to sustain it? Well, that pipeline is being driven by a 1.6 to 1 book-to-bill ratio. In plain English, that means for every single dollar of product they shipped out the door and billed, they booked $1.60 in brand new orders. Management actually noted this is the highest quarterly bookings in company history. A ratio this massive signals incredible backlog momentum. Demand is literally blowing past their ability to supply right now, which gives us tremendous revenue visibility for the next 12 months. Section 2. Dissecting the growth engines. Where is all this money actually coming from? If we look at the Q2 baseline revenue split, we get a really clear picture of how their core markets stack up. Industrial and defense is actually the heavyweight here, pulling in $120.7 million. And that makes sense. MACOM has super deep roots in high-performance RF, microwave, and defense tech. Telecom did a respectable $70.1 million, but the data center, sitting at $98.2 million, that's the one you need to watch. It wasn't the biggest slice in Q2, but as you'll see in a second, it's the true rocket engine for this entire business. Just look at how this momentum snowballs into their forward guidance for Q4. Management is expecting the data center segment to grow by roughly 35% sequentially. They actually raised their full-year growth outlook for data center to over 60%. This is being fueled aggressively by hyperscaler demand, 1.6 terabit optical deployments, and advanced co-packaged optics. Industrial and defense is humming right along too, guiding for about 20% sequential growth. Telecom is kind of the laggard here, looking at low single digits, mostly because it's highly dependent on the timing of low Earth orbit space programs. But driven by all this massive demand, MACOM just upgraded their total served addressable market to a staggering $15 billion by 2027. Section 3. Margin expansion and operations. Scaling up revenue is great and all, but are they actually making money on it or just burning cash to grow? Check out this margin progression. Back in Q2, their adjusted gross margin was 58.5%. By Q3, they pushed that up to about 60%. And looking ahead to Q4, they're guiding to break that 60 to 61% barrier. Plus, their GAAP operating margins skyrocketed from just 14.9% a year ago to a very healthy 22.5% in Q3. So what's the secret sauce here? It's basically increased capacity and utilization at their Lowell, Massachusetts and North Carolina fabs. They are pumping more wafers out the door with way better yields, and that drops right to the bottom line. But this right here is the absolute golden ticket, the divergence between revenue growth and OpEx growth. Revenue shot up 35.8% year over year, right? But their operating expenses grew at a much, much slower pace. Because of that, total GAAP OpEx actually dropped from 40.4% of revenue down to 35.8%. And the best part is, they didn't do this by starving the company. R&D still grew by 17.2%, and SG&A grew by 25.4%. This proves they have exceptional operational leverage. They're scaling the top line way faster than their costs, all without sacrificing crucial investments in next-gen tech like gallium nitride and indium phosphide. Section 4. Following the cash flow. You know, the income statement can sometimes be obscured by accounting rules, so the ultimate truth teller is the actual cash moving in and out of the business. Looking at the first 9 months of the fiscal year, this dynamic is exactly what you want to see as an investor. MACOM raked in $201.6 million in pure operating cash flow, and against that, their capital expenditures, the money spent on actual physical assets and fab upgrades, was only $46.9 million. That healthy spread proves incredible management discipline. They're extracting massive amounts of cash from their day-to-day operations without having to bet the farm on massively expensive new factory builds. So let's summarize the balance sheet. They ended Q3 sitting on a mountain of cash, about $663 million in cash and short-term investments. That puts them in a super strong net cash position. Plus, they are actively deleveraging the business. They proactively paid down over $161 million in convertible notes, which brings their total remaining debt down to $340.5 million. And moving forward, management expects full-year fiscal 2026 operating cash flow to easily top $300 million. By every objective measure, this balance sheet is a fortress right now. Section 5. Hidden flags and insider moves. Reading the fine print and footnotes. Headline numbers can definitely be deceiving, so it's time to dig into the dirt and see what management is doing behind the scenes. First up is a major red flag I like to call the GAAP earnings illusion. If you only skim the press release, you'd see a GAAP net margin of 29.4%, which looks absolutely phenomenal. But if you actually dig into the footnotes, you'll see that net income was artificially juiced by a $41.5 million one-time fair value gain on an investment. That has literally nothing to do with their core business of selling semiconductors. Once you strip that out, along with $24.5 million in share-based comp and amortization, you get their real adjusted earnings. Now, don't get me wrong, those adjusted earnings are still very strong, but that $41.5 million bump is a classic accounting optical illusion you need to be aware of. Before we look at executive behavior, let's do a quick refresher on Rule 10b5-1. Basically, this is a prearranged trading plan that lets insiders of publicly traded companies sell a set number of shares at a predetermined time. It is 100% legal and specifically designed to avoid any accusations of insider trading. I bring that up because while MACOM is experiencing this unprecedented growth, the insiders are definitely taking chips off the table. Just in the recent quarter, CEO Stephen Dawley sold over 15,000 shares for an estimated $5.78 million. Senior VP Thomas Wong sold over $1 million worth. All in, insiders dumped about 25,800 shares valued at $9.2 million. Again, these were scheduled under those 10b5-1 plans, so it's entirely by the book, but as an investor, you've always got to pay attention when executives are cashing out millions into a massive rally. Let's rapid fire a few more flags from the audit. On the red side, inventory levels are climbing fast, eating up cash and hitting $281.5 million in Q3. Management claims this is just to support future demand, but it's a spot we absolutely need to watch. Second red flag, the valuation is incredibly stretched. The P/E ratio is sitting at a lofty 85.59. You are definitely paying a steep premium here. But on the green side, they're insanely efficient. They're bringing new fab capacity online in under a year with barely any capex. And surprisingly, their adjusted tax rate is locked at a ridiculously low 3%, thanks to deferred tax assets, which is shielding their profits heavily. Section 6, the analyst's final take, synthesizing the gauntlet. Let's bring all this data together for a final verdict. Synthesizing it all, MACOM is without a doubt a fundamentally excellent business. Their economic moat is widening, backed by a $15 billion addressable market, vast diversification from space satellites to data centers, and advanced proprietary tech like GaN and PAM4. The bull case here is undeniable. They have flawless operational leverage, a record-breaking backlog, and a massive tailwind from AI and hyperscaler data center demand. But the bear case is just as glaring. At an 85 times PE ratio, this stock is priced for absolute perfection. Any slight stumble in execution is going to be heavily punished. And the fact that insiders are actively selling millions of dollars into this rally suggests they know the valuation is pretty rich right now. So what does this all mean? The fundamentals point to massive, undeniable operational growth and cash generation. But that sky-high PE and the constant insider selling definitely suggest caution. You've seen the raw data, you've seen the hidden flags. So which side are you on? Does aggressive 60% growth in the data center really justify paying 85 times earnings today? Dive into the filings yourself, do your own homework, and let the numbers guide you. Thanks for joining me on this explainer, and keep learning.